And happy Wednesday, August 26th. Welcome back to another exciting edition of Rate Desk. I am your host, Michael Thomas, here to talk about multifamily interest rates and other news. First, going to the markets, they all closed up on record highs for the session today. We do continue to see some rallying and strength in the markets based on investors' perception that the Federal Reserve is going to continue to keep interest rates low for a while, and also, very important, purchase debt. Purchase those bonds and purchase debt. So that is helping to keep rates low and keep the investors in the market feeling good about the future of companies. So that is what's going on there. We're not seeing a major difference to the 10-year U.S. Treasury yield. It is up a little bit. It's had a bit of a 3-day run moving up, but still seeing it under 70 basis points, 0.70. So closing around 0.69 today. If you recall last week's episode, we were at 0.67, so up just about 2 basis points. Nice to see that the crude oil futures are now in the $43 barrel range. The little asterisk on that is we do have this big tropical storm Laura headed towards the coast of Texas and Louisiana. Now it's been categorized as a Category 4 storm, and there are some evacuation orders. So there are oil production facilities in some of those areas that could be impacted by that hurricane. But that is to be seen. Jumping over to the multifamily interest rate market, rates are still remaining quite low. Looking at the FHA 223F fixed rate permanent, that is at 2.20. That is 220 fixed for 35 years. And on the 221 D4 new construction 40-year fixed, that is at about 2.80. That is 280. Remember, those are the interest rates and don't include the mortgage insurance premium, also known as MIP, which sometimes can be lower or higher depending upon affordability and if it's energy efficient or not. Jumping on over to the agencies, we are still seeing the Fannie Mae debt kind of at the low, just under 3% range. The high 280s, 290% range is the low end of their spectrum. And Freddie Mac is quoting a little bit tighter now at around the 309 range. A note on the GSEs I want to bring up regarding student housing. Okay, with HUD, the HUD program does allow multifamily housing that has students in it and can be located near universities, but traditional student housing, meaning you might have several people renting in a single unit, sharing a bathroom, things like that, are not a part of the HUD FHA insured lending program, but the agencies do have programs for student housing. And I would say they've been some of the most robust lenders in that space. That said, they are getting a little bit more conservative based on some of the news regarding universities closing, maybe going to a virtual classroom setting going forward this year. So they are taking a hard look at collections, stabilization, and they really do want to see that it's doing well, the property is doing well, and they want to see that consistency in the rent rolls. Leverage is lower, probably not going to see the top end of that range for a while. So my guess would be 65 to 70% ish would be where you're looking at leverage on those, of course, depending on the market in which you're located in. But student housing, more cautious there. And in other news, I want to mention some positive stuff that there's evidence rents are stabilizing. Looks like they came up nationally about $2 on average per rent. So that's good to see that. Obviously, we don't know where the rents are going to head from here, depending upon a lot of stuff related to the workforce. But it is nice to see that they're stabilizing. That outlook is pretty strong. Jumping on back over to the HUD desk, I just want to mention, and I know I've mentioned this in previous episodes, HUD is experiencing record volumes, which is not untypical for times like these. Remember, HUD is counter-cyclical, so they are really the lender of choice when there's market disruptions like we're in currently, and they are backlogged quite a bit. They are still in the regions that we operate in at the company I work for, Gershman Investment Corp, we're seeing processing timelines meet HUD's 45-day to respond to an application. There are some regions, in particular the Southeast right now, is very challenged in terms of staffing. They are pretty much overwhelmed on the HUD underwriting and also even on the contract underwriting. They have put in a request to get more help, but you can't blame them. They're doing $800 million more year over year than they did last year with the same amount of people. So that kind of explains that. Just to give you an idea of one regional office really for HUD, Southeast regions already closed this year 188 loans. That is 3.4 billion with a B this year, if you can believe that. That is a lot of volume. I expect we're going to see just unprecedented numbers when HUD closes the books for the year. So my advice to you, if you want a HUD loan, is get in line now, talk to your lender, get in early. There might be some extended wait times in some offices, although there are some offices that are meeting their processing timelines. And of course, they're helping each other out. So there's some load leveling happening with regional offices that may be less busy, which is great to see. That is my conclusion for today's episode. I look forward to seeing you all again. Come back to Rate Desk next week for a live update on interest rates, market news, and other things pertaining to multifamily. I'm your host, Michael Thomas, signing off.